Yeah, hello everybody. First of all, I want to recommend if you want next week on Wednesday, that I have invited Mr. Gerlach from the Bundesbank and he will talk about interest rates, and explicitly today we will also talk about interest rates and especially about interest rates and their dependence on exchange rates. And of course, this is a very relevant topic since we see that inflation is increasing, which in general would mean that we also have to increase interest rates in order to provide price stability. And on the other hand, explicitly in Germany, we see the stagnation of the economy, which on the other hand would mean that it would be nice if we obtain a push from the monetary policy side, which would mean a decrease of interest rates. So we are in a very hard situation like this. Okay, but we had talked about tariffs, and then I want also, since you should write your term paper, and I also said that you should write something about the exchange rates and in general about foreign direct investment and balance of payment in general. Therefore, I will also talk a little bit about what I mean by this. So in general, well, the balance of payments, this is uh, where we find all the statistics. So everything what we are trading with each other. So we of course find there the trade balance, and this means goods and services. And if you maybe also remember the macro course there, I talked about the difference between a gross domestic product and gross national product. So a guy who is an inhabitant of Germany working abroad, for example, in the Netherlands, this one guy is not included in the gross domestic product because its income comes from abroad, but it counts to the gross national product. So we have somehow income flows between the countries, and these we see then also, of course, in the balance of payments. Um, and taking all these together, so the very classical trade of goods and services, and then income flows due to this aspect about which I just talked. This together is then called the current account. So income flows. Well, but if I'm selling something, if I'm buying something, this of course, on the other hand, initiates capital inflows or capital outflows. And since we have here a balance sheet, I have activa and passiva. So if I have an inflow at the one side, I have to have an outflow at the other side. And so the other position of all these events is then done in the capital account. And overall, by definition, this you know, a balance sheet, activa and passiva, the sum of both has to be zero. So by definition, the balance of payments has to be balanced just by definition. Just by definition. Well, and here you see also this aspect of this crazy guy in the United States, because he has the aim, especially that he says, well, I want to have a trade balance of zero, well, within a framework of flexible exchange rates. It is hardly to argue that this is a good aim in economic policy. Okay, so this just for the definition of the balance of payments, and then since we are valuing all our good and service flows within a currency, then let's talk also if we have different currencies between trading partners, what we understand by exchange rates. And an exchange rate is nothing else than the exchange ratio between these two currencies. For example, dollar to euro. So how much euros I obtain for $1 or the other way around. And there you have to be a little bit careful, because you can define it in the first. This is called quantity or indirect quotation. And here we have to be careful. Now we are sitting in Germany, in Europe. So this is from the European perspective. And then, well, I ask how much US dollars I have to pay for €1, or the inverse, and this is called the direct quotation. Then I just ask the inverse, how much euros I have to pay for $1. And maybe if you are surfing in the internet, and let's see, you just look for the euro dollar exchange rate. And since I posed the question in German, then of course I end up with European web pages. And then you see here I have this indirect quotation. So how much US dollars for €1? But let's see. Then you find 1.17, the actual exchange rate. And if we take US dollar euro, maybe we end up at the, yes, here we are. Directly, not the European Central Bank. Also in behind there is of course it looking, let's say we want to go to Bloomberg, a provider from the United States. And then you see you do not find this 1.17, but just the inverse, so 0.084. Because here the exchange rate is just provided from the US perspective. And there you have to be a little bit careful that you are not mixing them up. So, and this would also mean that direct and indirect quotation would just change if you say, well, I do it from the US perspective. Okay, so this just for the definition. And then I show you some examples where, yeah, maybe we can say that we see something interesting looking at the development of exchange rates. And when you do your research for your country, then just have a look at the development of your exchange rate. I think I chose for everybody, I chose European countries. So then, of course, it would be interesting the exchange rate with respect to the euro, but also for the, I call it the world currency is unfortunately still the US dollar. So it will be also interesting to look at the development with the US dollar. And maybe then you see also some interesting aspect. So let's here start with the development of the exchange rate with Switzerland, so the Swiss franc. And well, then we at first see here 2008, and then we come from roughly 1.5, so 1.5 Swiss francs for 1 euro, and we moved to almost parity. So within 3 years, we had a movement. Here we have roughly 1.5, and here roughly 1. So this is then an appreciation of the Swiss franc of 50% within 3 years, which is quite a lot. And yeah, during this time, especially from Germany, Switzerland is a nice country, and we are going there for holidays, and then through the media, it was written, well, the pizza margarita is the cost is now around 17 euros or something like this. Not because the price in the restaurants has changed, but that for 1 euro you have not obtained when you went to holidays 1.5 Swiss francs, but only 1 franc. And if you look at this aspect, maybe you have an idea what could have been the reason in the aftermath of the financial crisis of this huge or very fast and high appreciation of the Swiss franc. If you think for what in economics or in financial aspects is Switzerland known for a long time. Yeah, well, in Switzerland, there is a long tradition to have a very strong banking sector. And if you go really far back in history, over time, even through the two world wars, Switzerland within the middle of Europe, although we had these two catastrophes in Switzerland, in this little country, this was always independent. There was no war during these times. And yeah, during these times, then in Switzerland, there more or less has developed this financial sector that if you have really turbulences somewhere else, then Switzerland is the place in the world where you put your money because then it will be afterwards still there. think of you have a change of government or of the regime, then of course it is a risk that your income, your money is not there the next day. Yeah. And this was then also the case during the financial crisis. Everywhere we haven't known what happens. And then many people just went to Switzerland and put their money there. And this is the so-called safe haven theory. You are looking for a safe haven where you afterwards still have your money. And this meant then a huge capital inflow to Switzerland. And a huge capital inflow then, of course, means an appreciation of your currency. So, large capital inflow due to the aspect of a safe haven for money. Well, and what then happened? For almost 3 years, the exchange rate more or less stayed constant. Do you know what the reason for this was? Because also, well, it was roughly 1.5, but during these times, we had still a fluctuation before the financial crisis, ups and downs. And here we have almost no fluctuation anymore. Well, the aspect is that if you look at Switzerland, that there, yeah, you have a similar situation as in Germany. Well, you have on the one side the very strong financial sector, but in Switzerland you have also many, many companies which are selling high quality products into the world. And what does a very high appreciation of the currency means for these exporting companies? So think of you have a good product produced in Switzerland and you want to sell this to France. And within 3 years, the Swiss franc appreciates 30%. What does this mean for you as an exporter from Switzerland to France? Hmm? Well, you lose competitiveness because just due to the development of the exchange rate, your products become more expensive for the buyers. You have to pay your wages, your input costs in Swiss francs. So you have calculated a selling price in Swiss francs, and the buyer, he has at first to exchange his currency into Swiss francs, but the euro has depreciated for the same amount of Swiss franc. I have to give now 30% more euros. So overall, within these 3 years here, from 1.5 to 1, this means a rise in prices or in export prices for the Swiss exporters of 50%. And this, of course, is very harmful. And within this situation, then the central bank in Switzerland stepped in and then they said, well, although we have flexible exchange rates, now we will intervene and we will stabilize the exchange rate. And their promise was we will hold it at 1.2. Intervention of the Swiss National Bank. Yes, goods become more expensive. Exactly right. Well, and if you now remember, we have really a huge capital inflow, especially from other European countries into Switzerland. So, in order to stabilize relative to the euro, the exchange rate, the Swiss National Bank, they had to buy euros because very much capital flows into your country. So they needed the Swiss franc. This goes up, and that you still have the same exchange rate. I want to fix it at 1.2. I have, on the other hand, to increase euros. So I have to buy euros. And how can I buy euros? And I have to do this not only 10 million, I have to do it in, um, and I think at the peak it was roughly 500 billion euros they had to buy. So what I meant by this example, you cannot just go to a bank and say, well, I want to exchange here 100 Swiss franc into euros. So with cash money, it doesn't function. There is not enough cash money to change the position like this. Well, this means you have to buy bonds denominated in euro. And what kind of bonds? Well, of course, then government bonds. And I really need 100, 200 billion euros in government bonds. So which government bonds then the Swiss National Bank had to buy in this situation in order to stabilize it at 1.2? Where do we find a relevant amount of government bonds? Pardon? No, the central bank doesn't issue the government bonds. It's the government bonds. Well, we have this discussion if we should go to the market with European bonds, but actually right now we don't have them. Well, then in general, we look at the Eurozone and what are the largest countries in the Eurozone. This is then, of course, Germany and France. So mainly they have to buy German government bonds because there are not enough bonds from Malta or Luxembourg or something somewhere else from these small countries. So this then meant that during this time, Switzerland was the largest debtor of Germany. Because think of 200, 300 billion euros. The government debt in Germany is overall 2000, roughly 2000, a little bit more billion euros. And this meant during this time, Switzerland hold between 10 and 20% of the German debt. Just because of the reason that they wanted to stabilize it by 1.2. But then, of course, you cannot do this over time always. Because on the other hand, this means for Switzerland that they have to print money. And this, again, increases inflation. So to speak, they bought in the end time for their export industry that they are afterwards, when then they released again here, again, flexible exchange rates that now the exporting companies, they had almost 3 years of time that they then can deal with a situation where then, and you see again, the exchange rate dropped, that we here roughly at parity at 1, that they now can deal with such a situation that you have a, so to speak, harmful exchange rate and you can still export. And then if you look at the actual situation, then you see not that fast as here, but again, since the end of Corona, we have also an appreciation of the Swiss franc. And there you have also, so relatively spoken, the situation that compared especially to Germany and the Eurozone as a whole, that the economic performance of Switzerland is better, and that the the agents at the capital markets again see high risks in the rest of the world. And again, maybe you can say that Switzerland is something like a safe haven, that they again have a large capital inflow to their country. Okay, so this just means read a little bit about your country. Maybe you find something interesting. Maybe it's only just a fluctuation you have for your countries, but let's see. Okay, so this was Switzerland. Here we have the United Kingdom, and especially if we look here, we have here this drop in exchange rate of the British pound. And if we look here at roughly 2015, what can we say? What happened there, more or less? Or not more or less? And then just here the upward. What is the fundamental change of the United Kingdom during this time? Hmm? So here in the development of the exchange rate, you just see the Brexit. So they just left the European Union. And so first we had the appreciation and then again the depreciation. So this was the voting about the Brexit. The Brexit itself, this just happened here. And what you then see in the development of this exchange rate is that although here during these years where all these negotiations, do they really leave the European or not? Here, this was the vote. And then also the government changed in UK, and it was not 100% clear that they really would leave or under which conditions they will leave. There were negotiations about 3-4 years. About the Brexit. And the interesting thing is, if you look in such situations at the development at the capital markets, at the development of prices, you see here already in 2016 to the exchange rate, there happened more or less nothing anymore. But still there were these negotiations. So what you then see is, so to speak, the expectation of the capital markets, what will happen in the future. So that you see here over this time almost nothing anymore. Because of course, when they really leave the European Union, they are not anymore a member of the European free trade market. That this is harmful for international trade and that this will, of course, change capital in and outflows. This is definitely clear. But nothing, and also at the event when they really left the European Union. At this date, also, you do not see anything in the development of the exchange rate. This means that just 3 years before the actual event, the capital markets more or less said, well, we expect they will definitely leave, and therefore we have now the price adjustment. So the price adjustment not happens at the actual event, it happens because of the expectations. So looking at this time series, then we can say already in 2016, the capital markets expectation was more or less, well, anyway, how long it takes, they will leave. So then we can say at this point here, capital markets expected a definite uh, or expected that UK definitely leave the EU. So, two other quite interesting developments in the exchange rate. So this is Turkey. And what you see here is, well, we are coming from roughly 2 and now we are roughly at 50. So a very, very large depreciation of the Turkish lira versus the euro. Well, and I say just from an economic standpoint that this is yeah, quite a nice picture, because then we see that our explanations how markets work, how capital markets work, that this is a reasonable model because it functions. Well, what we see here, we have that the situation in Turkey really changed. So let's say until so roughly 2010, there was still this initiative that they want to come closer to Europe. And there was even discussed that Turkey becomes a member of the European Union. And then, yeah, the views on the world, they drove apart. We have explicitly also a change for a more autocratic system. Well, and what means an autocratic system for investors? Well, it just means that the risk that my money is not there tomorrow, or my money is still there, but the government there just says, well, it's now my money, that this risk rises. And then you cannot be very surprised that you have large capital outflows. And here you see then in this very large depreciation of the Turkish lira, the power of the capital markets. And I have to admit, only the capital markets can drive the crazy guy in the United States in the right direction. Remember, he just reacted when he have imposed or started with his tariffs, and then we had the stock market crash. Then he reacted and did something else. And more or less the same you have looking at Russia. Actually, this is the data from the Bundesbank, and therefore in 2022 the time series stopped because then we initiated all the sanctions on Russia, and therefore officially it is not allowed to exchange anymore. And therefore I gave you also from a financial market data provider here the ongoing exchange rate. Of course, in behind still euro is exchanged against the Russian ruble. But of course, you have also here the very large depreciation of the ruble versus the euro. And of course, in the situation with this horrible war, that you have outflows of capital, that the international investors are leaving Russia. This is, of course, also not a surprise. Then let's talk about the last one. Here, maybe we start better from the right. This is US dollar versus the euro. Well, in general, I showed you this time series also in macroeconomics. This more or less, these are the two most important currencies in the world. So the only thing, so to speak, what you can see here, well, it is fluctuating. But you have also to admit if you have flexible exchange rate, then fluctuations of, and you see here coming from 1.2 to 1.6, going down to 0.8 or zero point 0.9 here of plus minus, let's say 20 percentage points is quite normal. Also, so just with these fluctuations you have in general to deal if you are an international company. But then I want to ask you, this is with the Chinese currency, and if you look at these two time series, euro versus US dollar and euro versus the renminbi or yuan, the Chinese currency. What do you see if you compare these two time series? They are very similar. And do you know why they are very similar? Or is it by accident? Well, of course, it's not by accident. The reason is that the Chinese government is manipulating the exchange rate, and they have the policy to more or less have a fixed exchange rate to the United States. And if they fix versus the US dollar, then of course it is not very surprisingly that you have done a similar development of the euro with respect to the Chinese currency, which is similar to the US dollar development. So reason, Chinese government is fixing its currency relative to the US dollar. And in general, you could say that they undervalue their currency. And what can be the reason in general? Chinese currency is undervalued. What could be the reason that they have the policy to undervalue their currency? Well, if you look at the international trade situation of China, what are they doing in the world? Look at your own consumption. What are you buying? Technology, and in the end, most of the, so to speak, small consumption goods, they are coming all from China. So they are, especially for consumption goods, the largest exporter in the world. And if you have an undervalued currency, this again means that you have a competitive advantage because your currency, your prices, due to the exchange rate, you can sell for lower prices at the world market. So this means an competitive advantage for Chinese export goods. Okay, this is what I wanted also to show you that you should just have a look at your development of the exchange rate of your country, and maybe you also find something interesting. Yeah, let's summarize this. In general, how do these exchange rate markets are functioning? Of course, we then can say we have a demand for the currency and a supply for the currency. Well, how do we get a demand for euro? Well, if we are exporting our goods, then as I said in the example of Switzerland, if now we are exporting our goods to the United States, then of course the buyers need euro to pay for our goods. And this of course then rises the demand for euro. Also, if some US tourists come to Germany or to Europe, visit our nice little continent in 10 days, you need also euros. This rises the demand, and this is then the aspect of direct investments, foreign direct investments. If US firms want to buy German firms or firms from France, then they also need euros. So in this way, the demand is created. How is euro supplied? Well, when we are importing goods, then this means that we have to sell our euro in order to obtain US dollars that we can buy the foreign goods. So then we are a provider of euro. Again, vice versa, when we move for holidays to the United States, then again we are exchanging euro into US dollars, and the other way around. When Europeans want to buy a US firm, then we function as a supplier of euro. And also then if you have this exchange rate, then in just comparing the prices internationally, then of course you also use the exchange rate. And now having these demand and supply of the currency, then we can go to the balance of payments. So a supply and demand for euro, supply of dollar or a demand for euro means now an export of goods. This is on the other way an import of capital. So here you see if you go to the activa and passiva side of your account that you find the physical exports on the left side and you find the capital imports also on the left side. And the other way around, demand for dollar and supply for euro means now imports of goods from the United States, and then, of course, the other position, capital exports. So, and here I put it within these arrows. They have to look together, that you have, if you have a demand for the home currency, that this in general would increase the exports and would increase the capital imports, and the other way around if you have a lower demand for your home currency, and vice versa at the other side of your account you find the same. Okay, so that's it, that you also have a clue of the dynamics within the balance sheet. So, and then the last aspect, which I already mentioned at the beginning, is now the dependence between exchange rates and interest rates. And this is called the so-called uncovered interest rate parity. And as we do it quite often, we are comparing different alternatives. In this case, how we can invest. Remember the Ricardo model. There we said, well, we have 1 day of time, and within this 1 day, we can produce good A or good B. So now we would ask ourselves, well, I have €1. This is my investment volume. And in the Eurozone, in Germany or France, I have an interest rate. So what will then, after one period, be the case if I invest in Europe? How much euros I then will have after 1 year if I'm investing with an interest rate, i.e. Let's say you have 1,000 euros and you are investing for 5%. With how much you are ending up then? 1,050. So mathematically, this is then 1 plus the interest rate. Okay, so 1.05 in this case, if this would be 5%. So now I want to compare these two investment opportunities, because I assume that I can also invest in the United States. I have my euro, and in order to invest in the United States, what do I have at first to do? Yes, and I go to the bank, and there I directly do this. So this is known. This is the nominal exchange rate today. So times E0 means I have now, let's say, this is 1.17, then €1 means I can invest 1.1 US dollar 17 cents in the United States. The developing is then I get the interest rate of the United States. So this one. So this would be then 1 plus I dollar. So now time goes by, 1 year later, but we are still today. So from the today's perspective, in order to compare these two investments, what do I also have to do with my a foreign investment, with my investment in the United States? Yes, but unfortunately, I do not know what is the exchange rate in the future. But again, I have some expectations about. And if I compare them, if I want to compare them, okay, then I have to divide by the expected exchange rate in the future. So this is the expected exchange rate tomorrow. Well, and now let's assume fully competitive markets and risk neutral investors. So what would then happen if the number on the right would be larger compared to the number on the left? What would happen? Well, I have two alternatives. I have my €1, and then I think, shall I invest in Germany or shall I invest in the United States? And then I look at the interest rates, I look at the exchange rates, I have my expectations of the exchange rate in the future. And if now this number would be larger than this number, what would happen then? What do I do then with my €1 investment volume? Yeah, then everybody would move to the United States. But what would this then mean? This is a capital inflow to the United States. And if I have fully competitive markets, so that also the price mechanism is really working, this should then lower because everybody is going to the United States. Then the rent in the United States should drop. The same argumentation is right if this number would be larger. So if this assumption is okay, that I have these fully competitive markets, what has then be the case with these two numbers? Or the interest rates or exchange rates, they have so long to change until both investment opportunities are equal, because this is the price mechanism and then I am in equilibrium. And this is then the so-called, from these assumptions, I get the so-called no arbitrage condition. Or in English is called, well, in functioning markets, there is no free lunch. Because otherwise, what could I do? I could go to Europe Let's say here we have the higher value, taking for the European interest rate a credit. Well, I have to pay for this, but then taking this money, going to the United States, there I earn more, then changing this back, paying the interest in Europe with my higher yield in the United States. I can fully pay the credit at home, and still I'm left with a definite um, with a definite income. And this would be then my free lunch if I would have such a situation. And therefore, we say with fully competitive markets, then there is no free lunch, there is no possibility of arbitrage within the market. And actually, if we look at the data, especially in the currency markets, we see that they are really close to fully competitive markets. So actually, if you want to exchange euros into US dollars, and you do it in Berlin or you do it in Hong Kong or Sydney or New York, worldwide you will everywhere find the same exchange rate. And then this dependence here, you see that the euro is canceling out. That 1 plus AI euro equals 1 plus IU dollar divided by the expected exchange rate. This is called the uncovered interest rate parity. Why uncovered? Well, uncovered means that within here I have the expectations. Well, and of course, these are my expectations. I don't know this. They are not fixed. And maybe you know that within the financial market, you have also the so-called forward exchange rates. So if you can make today a contract that I am allowed to exchange for a fixed exchange rate in the future, the US dollars against the euro. And then I definitely know what will happen or what exchange rate I have personally in the future. And this would be then the so-called covered interest rate parity. But for this, actually, we do not find in the data that we have this equality sign in general. And the reason for this is that you can say that these forward contracts for the future, that these are not really market prices, that this is more or less some kind of insurance for the future. Actually, the airlines do this quite often because this is going through the media that especially the prices for kerosene is going up for the fuel of the planes. And so in general, they insure themselves against a rise of the fuel prices at the world markets, that they make contracts today. Well, tomorrow I can still, with the same exchange rate, buy the fuel for my planes. So in the short run, this is my expectation. We will not directly see that there will happen something, but within 3 months or 6 months, when these forward contracts are ending, then we will see how the markets in the flight markets are changing, and we should not be surprised if then also the ticket prices will rise. But in the short term, they have these contracts that they do not have directly to pay the high prices. Okay, and also another nice little aspect about this formula is the following. Well, we can then write that the expected exchange rate is just, we take this on the left side, multiplying with the expected exchange rate and dividing by the interest rate factor of Europe, we obtain today's exchange rate, today's interest rate factor of the United States divided by today's interest rate factor in Europe. And if we have such a dependence in economics, we are always very happy if we also can take from historical data that this concept here is also okay from an econometric point of view, that we see really that our argumentation holds within the data. Then we have the nice little thing that this is known today, this is known today, and this is known today. So variables are known today. This is the expected exchange rate. This we do not know. Number in the future. Well, and then the nice little thing is that we can calculate a not known number out of known numbers today. So we can interpret this model of the uncovered interest rate parity as a possibility to forecast the exchange rate in the future. So then we can forecast the exchange rate via the uncovered interest rate parity. Well, unfortunately, it of course does not 100%. It does not fit for 100%, but we know from history that it is, if you want to know where is the exchange rate adjusting in the future, that using this interest rate, uncovered interest rate parity concept is a quite good idea in order to have an idea where it is going into in the future. Okay, this I also summarized here. Well, and what we also can say is that in general, if we are using other models in order to forecast the exchange rate in the future, then ex post, we very often find that there are better models than this one, which I call here now the naive forecast, that we on the one hand know we can be better, but the pity is that we do not know which is the right model in the future. So it is not from the data we do not see, well, there is one model which is in 9 out of 10 times better than this naive forecast. So since this always changes, on average, it is still a good choice to use this uncovered interest rate parity. Well, so this is then, so to speak, from practice. Then in general, we have also a concept, well, how should be an exchange rate, or in which region should we find an exchange rate? And this is the concept of purchasing power parity, and this hopefully you also know from macroeconomics. I have done this in my course. In general, we are valuing our currency using this concept of a representative consumer, so a representative consumption basket. Remember how we calculate consumer price index. So we look on average what kind of goods we are consuming, taking the prices, taking the weights, summing all these up, then we can calculate the value of a representative consumer basket. Well, and then we know how much this consumer basket costs in Europe in euro. And then let's say take another developed country, namely the United States. There we more or less can assume that the preferences are quite similar compared to euro. So let's take then the same basket in the United States, doing the same, summing all up, now valued in US dollars. Then we have the overall value of this representative consumer basket in US dollars and in euro. And then just these relative price level in general should also represent the exchange rate of the two currencies. And this then, yeah, if this would be right, then this would mean that more or less we have only one price around the world. Of course, in practice, we do not find this directly because you have everywhere transaction costs. Also, you have different preferences. An average consumer basket um, in Germany will of course differ to an average standard consumer basket in a developing country in Africa. But in general, from a theoretical point of view, this concept of purchasing power parity gives you at least something like a hint also where in which region you should find um, an exchange rate. Well, of course, then it is yeah quite hard to calculate these purchasing power parities. The IMF, this is done, but there's of course also not only the right concept how to do it, but there is something very nice, I think, is that I think roughly 20, 25 years ago, the guys from The Economist, this economic newspaper, maybe you know this, they had an idea. Well, let's try to find somehow a proxy of this purchasing power parity. And for this, they ask, well, we look at one single good which is provided almost everywhere in the world. And what is also important, the preference for having this good should be more or less the same all over the world. And what they then invented is the so-called Big Mac index. So maybe we can, it is a good assumption that the preference for buying a Big Mac is just that you are hungry. Also, at least in every larger city in the world, we can say you can find such a burger. And what they then are calculating is just what are you paying for this Big Mac in every currency in the different countries, then we know, of course, it's coming from the United States, and we are calculating also these purchasing power parities relative to the US dollar, because still the US dollar is the most important currency in the world. So, and then we can look how much in home currency costs this Big Mac in the country. Then we have the actual exchange rate. There we can go to the bank, and then we can see, is this good, relatively more expensive, or is it less expensive compared to the United States? So then we have a hint, is our currency in tendency undervalued or overvalued relative to the US dollar? Well, and the unfortunate thing is, until last year, the data for this was free, and right now you cannot anymore directly download it, and you then have to have an account at The Economist, which I do not have, but I found here at least a database where I'm not allowed to download here the data, but at least you see the data. And then what you see here is that it is ranked from the most overvalued countries to, where do we have at least one? One is the United States. No, they do not have them. But if you would have here then a zero, here from plus to minus, there it is changing. That you see measured via the costs, which a Big Mac costs, for example, in Zurich, relatively to New York, that the Swiss currency is 50% overvalued. So the exchange rate of how much do I have to pay for a Big Mac in Zurich compared to compared to New York is 50% higher than the exchange rate between the Swiss franc and the US dollar. And then you see here the Eurozone right now. This is actually also due to Mr. Trump, that we are quite overvalued relative to the United States, and but there are not many countries, and the rest then here is undervalued. Well, for example, let's just cut some of these. This was, I think, yep. And some more undervalued countries. And here you see also what I said. Here you have more or less the evidence, which I told you, that the Chinese currency is highly undervalued. They are fixing their exchange rate. And here you have then also the evidence that it is undervalued. So let's cut this also. Some examples. Oops. Then let's shrink this one. And we have this here. And in order to be complete, oops, where did I stole this? There. Okay, now that's it, and we are through for today. Yeah, and also be careful when you are writing your term paper and you are showing data, then please provide your sources. Yep. Okay, that's it. Thank you very much.